Randy Turner from Dallas, and we located Don from Surfing the Net and looking at two or three other options trading sites that look more like they were scams than anything else to get your money. And every trade so far that I've done with him, I haven't done every single one of them because I've actually maxed out my cash now, but every single trade that I've been in since day one, I am profitable in every single one of those. And I'm getting a lot out of this. I highly recommend it.
I'm Mike Semmett from Atlanta. I've been investing in the stock market for about 15 years and probably barely beat the S&P 500 in that time, which is actually unacceptable returns in my opinion. So Ray and I found Don about 3-4 months ago, called him up, basically interviewed him, and I joined him 5 minutes later and invested immediately, and my returns in 3 months have been phenomenal. And after this seminar, which just confirmed everything and gave me a little more confidence, I'm going to be doing this full time. I have enough cash put away, and the returns I've enjoyed for 3 months, if that can sustain, that's all I need to live on. So thanks, Don. You're the man.
Let's first explore investing in stocks versus options. Stocks obviously require a much greater capital investment, and hence it lacks the leverage that options might offer. Option spreads allow you to use other people's money to lower your investment cost and hence lower your risk and increase your percentage gain. Let's talk about some of the myths that are out there concerning options. The options are very misunderstood. There are perceptions that options are risky because investors do not understand which options to buy versus the underlying stock. Buying an in-the-money option will move point for point with the stock. This is a double-edged sword. You will gain point for point with an up move, assuming that you have not paid for the time premium, which you will lose as time approaches expiration. Out-of-the-money options have less risk and more leverage per dollar invested, assuming that you are correct in the direction of the move of the stock. Let's talk about the range of different types of option strategies. There are calls, which give you the right but not the obligation to buy the stock at a specific price for a specific fixed period of time. Remember that it's a wasting asset that you're buying, and it's a wasting asset for the buyer, but it's a source of income for the seller. Puts are an insurance protection for the buyer. They give them the right but not the obligation to sell the stock at a fixed price for a specified period of time. It too is a wasting asset for the buyer, and it's a source of income for the seller or writer. The writer is analogous to an insurance underwriter who writes a policy and receives a premium for doing so. We think that the writer should buy cheap, out-of-the-money reinsurance to protect themselves against potential loss. Spreads are buying one option to protect the risk of selling another option and lowering the cost basis and creating profit. This applies to both puts and calls. Why calendar spreads are the best path to profit and protection, and why are they used by private investment teams who manage high net worth individuals' portfolios? because they allow the investor to profit by the passage of time, not necessarily prediction of the direction of the underlying stock. The investor becomes an insurance underwriter, writing policies for premium return. They can also trade the puts that are sold at higher premiums and repurchase them at lower premiums and nail down specific profits. Conversely, they can sell calls at a high premium and repurchase them at a lower premium or price, thereby nailing down profit. We're capturing more and more time value premium, and that is the name of the game, because we're going to earn that time value premium by the mere passage of time.